Hi everyone, welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. My name is Atira and I will be the moderator for today's session. Our topic today is cash flow analysis, finding financially robust company. Profits can make a company look strong, but looks can be deceiving. The real test of financial strength is cash flow, the movement of money in and out of the business. Cash flow shows if a company can pay its bills, invest in growth, and survive tough times without relying too much on debt. It's what separates looking good on paper from being truly resilient. So today, we are honored to have Miss Pauline Yong, CEO of Sigma Wealth Sdn Bhd, to share with you with her technique in decoding the cash flow statements. Before we proceed, allow me to make a short disclaimer. Please be reminded that everything that is shared in this session is mainly for educational purpose, and by no way we are providing you advice to buy or sell any securities. You are 100% liable if you make any investment decision. Now, let me introduce our guest speaker today, Miss Pauline Yong. Miss Pauline Yong is the CEO of Sigma Wealth Sdn Bhd. She is a certified financial planner, CFP, and a licensed financial planner with Securities Commission license, CMSRL, and Bank Negara licensed financial advisor representative, FAR. Currently, she holds the chairperson position in the Financial Planning Association Malaysia, FPAM Johor chapter, and she is also their course facilitator for the FPAM CE courses. Miss Pauline is the author of 5 investment and financial planning books, including the MPHM popular bestseller I Love Stocks and I Love Trading. She is also the first female certified chartist, CFTE, in Malaysia and a member of the Society of Technical Analysis, STE. She received her MBA in Finance from University of Leicester, UK, and her BBA Honours in Finance from York University, Canada. With that being said, let us warmly welcome Miss Pauline Yong to the floor. Good day, Miss Pauline. How are you
Hello.
today?
Hi, Atira.
Hi.
Hi, good morning.
Good
Good morning,
morning to you.
everyone in front of the webinar. How are you this morning today? Okay.
So I will
So,
pass the slide to you, okay?
okay, thank you. Okay, so
Um,
let me share my screen. Okay, so today's topic is a very interesting one. It is called the cash flow analysis, finding financially robust companies. So what we're going to do, so this is the agenda, okay? So we are going to look at a detail to look at the the cash flow statement in detail. There are 3 sections, so we're going to look into details. And then so that you can understand the mechanism behind the cash flow statement. And then we will also look at some of the real case studies. Okay, so you may also, if you have any questions, please type in the Q&A section. If let's say later you want me to analyze certain stock name, you can type the company name in the Q&A, and then when we have time, we will look into those real cases as well. I do have some prepared ones, but then if we have time, we can look at more cases, okay? Okay. So, Lavins, Rosely, good morning. So the cash flow statements. Now, in the financial reports, we have 3 important statements. So the first one is P&L, profit and loss, which is called the income statement. And then we have the financial position, which is called the balance sheet. Okay. And then the next one will be the cash flow statements. Now, most of the time, people focus on the income statements and the balance sheet, right? And not many people actually look into the cash flow statements. So a lot of people, they may have some misunderstanding about how we look at the cash flow statement, how we analyze it, and then what's the significance of a cash flow statement. Now, a cash flow is the lifeblood of a business. So when we are looking at the financial health of a company, right? So we will look at whether this company, whether you are able to continue, sustain your business. The cash flow analysis is super important. So meaning you may have a big sales revenue. You may have a big sales order. Like, okay, later I will show you the company name. Maybe this particular company called A company or X company, whereby the orders or the revenue can be in billions. Okay, the sales revenue can be in billions. But however, when it comes to the cash flow, there is some form of you can see that there is some form of inadequate, okay, liquidity. There's some form of a problem in the liquidity problem. And it could be due to the industry itself. Because sometimes when you are operating in a certain industry, right, you are looking at buying things from the supplier. So when you need to buy things from a supplier, you need to pay the cash to the supplier. And then on the other hand, you are going to invoice your customers. So when you're invoicing your customers, you will receive your cash later. So in certain business, right, there are some business which is by nature is more liquid, cash liquid, okay? And then some business by nature will be less liquid. So can you give me some examples what are the businesses that are more liquid? Okay, type in the chat here, okay, the webinar chat here. What are the businesses that are more liquid by nature, by the way that the business is being operating, by the industry? Supermarket, very good. Okay. Oil and gas, are you sure? Cafe, yes. Okay. So banks, okay, banks, yeah, because they have certain rules, right? So if let's say you cannot pay, then they can auction your whatever properties. Toll collector, very good. Magnum, very good. F&B, okay, software services, okay, very, very good. Now, then my next question is, what kind of businesses or sectors that are less liquid cash flow? Okay, which sectors or industries are less liquid? So this one, you have to think of what kind of a business that the payment, okay, the collection, it will take months for you to collect. Yes, very good. Construction, it will take months. Okay, I'm not sure how many of you are in the construction sector, but my family business was in the construction business. So that was long time ago. And one of our problem was actually to collect money from the debtors. So that is our big problem. So every day we are looking at which debtors we want to collect money from. Okay, mining, okay, and manufacturer, yes, okay, all this, as long as you are doing some form of a production, manufacturing, construction. As for the properties, I don't think so, because properties you are able to collect money. Once you are able to sell your properties, the bank will disperse the money to you. So should be okay, okay, unless your receiving is due to the certain terms and condition you are receiving at a later stage. But normally the normal will be the manufacturing, the construction, and technology. Okay, it depends on the tech company, what kind of a tech business. Like for example, the service, like a software, this kind of a software service base will be easier to collect money. But if you're looking at hardwares, okay, the IT hardwares like chips, then you are considered as a manufacturing. So manufacturing, you are considered as a problem with the collection of the money. Healthcare like hospital, right? So if you're looking at hospital, so if you do not pay the deposit, will the hospital allow you to admit to the hospital? No, right? So I think the hospital wise, it is still considered as a cash flow is okay because of the way they do business. So whenever you are checking in, I mean admission, you have to pay deposit. And then as you are proceed with your treatment, they will ask you to top up. Okay, if you do not have money to top up, they will, basically they will ask you to leave. So I think healthcare is good. But if you are asking about the um, gloves stocks, I mean the glove manufacturing. So then you are looking at the manufacturing company again. So as long as you are falling under the manufacturing category, you are bound to have this kind of a problem. That means collection problem. You're gonna have a problem in collecting your revenue. Okay, professional services are cash based as well, because if you want to engage with my service, most of the service industry, I would think that they are cash based. Okay, logistic, yes. Okay, logistic will be another problem. They will drag and drag and drag because the logistic link to the manufacturing and then link to the construction. So all this whole are all linked together. So when they are trying to delay one another, because they have delay from the customer, so then they will delay their supplier. So then this logistic are all the suppliers of the construction company and the manufacturing company. So these are all will be delayed. Okay. Very, very good. Okay, so you have a very good understanding now. E-commerce is cash, okay, because you are looking at when people are buying, so you are paying first, and then you can receive, so cash. Okay, good. So then when we are able to look at the industry on a whole, right, then we have some form of understanding about which industry basically by nature it will be more having some cash flow problems. So when we are doing analysis, we have some leeway. Okay, so we say that, okay, this industry we will expect 20%. Okay, operating cash flow margin 20%. Whereas construction maybe will thinking of maybe 10% is good enough. Okay, so later we will see. Okay, we'll check some of these construction and manufacturing. Okay, so then we are able to look at the investment opportunity as well. So what's the difference? Okay, so when we are looking at cash flow versus the profit, okay, the profit means your P&L, your net income. So when we're looking at these two, right, what's the difference? Okay, so net income, right, profit is an accounting figure. Cash flow tracks the real cash inflow and outflow. Okay, so this will be the main difference. Whereas what is an accounting figure? Accounting figure will take into your depreciation, accruals, and things like that. So what does depreciation means? Depreciation means that if you have assets, then you need to expense it, okay, in the lifetime of 10 years, so that every year you will expense a certain portion of the assets as a form of a depreciation. Okay, so there is no actual cash outflow, but then in the accounting base, you just need to deduct the depreciation. Okay, no actual cash outflow, but then because of the accounting purpose, you need to deduct from your net income. So that means your net profit is like this, but then because you need to minus your depreciation, then your net profit becomes smaller. Okay, but if you want to calculate your cash flow statement, you have to add back. Okay, add back this kind of a non-cash item like the accruals and the depreciation. You need to add back to your cash flow statement. Okay, so that will be your real cash. So example, a company can show profit but have negative cash flow due to unpaid receivables. So strong cash flow indicates sustainability, and weak cash flow signals potential insolvency. So significance is to help to identify robust companies that can fund the growth internally. Okay. So let's look at the cash flow statement. So this is a sample of a cash flow statement whereby we are looking at 3 sections. So you have the cash flow from the operation, whereby you look at the core business cash generation, and then the cash flow from investing and the cash flow from financing. Now, these 3 sections, right? Can anybody tell me which one is the most important one? For the healthy wise, okay, like whether this company is healthy or not, which one is the most important one? That straight away you see that, very good. Okay, Harriet, very good. Okay, yes, Rusli, very good. So it's the operation. So it could be, for example, okay, it could be you have a lot of cash flow from borrowing. Let's say this company is not really doing any business. Okay, the operation wise is actually not much, but then however, they are borrowing a lot of money. So then you know that this company is not a sustainable company because they have a listed position. It's just to, generate the cash from the financing part. Okay, so it is very important that the operation has to be a big positive. Okay, meaning that your inflow must be greatly less, more than the cash outflow. So meaning the cash receipts from the customers, this figure must be much, much bigger than the cash outflow. Okay, so that then you have a big positive from here. And how about this investing? Okay, if you look at this investing, right, you are looking at cash receipts from the sale of the property and the equipment, then you have a cash inflow. And then when you are buying the equipments, then you have a cash outflow. So here, do you prefer to have a positive figure or a negative figure? This one, the cash from investing. Would you prefer to have a positive figure or a negative figure? If it's a positive figure, it's good. Or if it's a negative figure, it's good. Okay, Harriet, very good. Yes, negative. Okay, a lot of people, they may think that, oh, everything positive is good, but however, yes, this session, it will be including the negative. It's because you want to see that this company is expanding. You are investing in your capital, like your capital investment, such as you're buying your equipment, your machineries, or even you are building a new plant or building a new production line. You are expanding your business. So you can see from this cash flow from investing. Okay. Yeah, negative but in a sustainable way. Yeah, that's right. Do account for receivable, accounts payable include in the cash flow? Yes. All these accounts receivable and accounts are here. You see the cash receipt here. Okay. Cash receipts are accounts receivable. And then if you want to pay your supplier, then it will be cash payable will be here under the operation. So this operation, right, will be your receivable, payable, and as long as something to do with your operation. So how do you operate your business? You operate your business is that you need to buy your raw material, like cafe business. When you are looking at the cafe business, then you need to buy the coffee bean, and then you need to grind it, and then only you can make some coffee drinks for your customers, right? So when you make some coffee drinks for your customer, then you collect money. So after you collect the money, then only you can pay your supplier the coffee bean. So then this will be your loop, one whole cycle, like your working capital cycle. Okay, so first you need to buy first, and then when you need to buy, you don't pay cash now. Okay, so when you are buying the coffee bean, you say, okay, I'll pay you in 1 month time, 1 month. So then you receive the coffee bean, then only you can do the business. So during the month, you want to sell as much of a coffee as possible. Then you can collect a lot of cash, right? So 1 month later, with the cash, you can pay your suppliers, and then that will be a one complete cycle. Now there are certain industry whereby the cycle is much, much longer. The payment term is like 2 months or 3 months. So for example, the construction or the logistic. Okay, so logistic, like let's say you are a lorry transport company. So then you will transport the goods for the particular company. So you don't collect the money upfront. Okay, they won't give you the money upfront. So you can only bill the company 1 month later. At the month end, then only you can bill, okay, this month I have so many lorries of loads. Okay, you calculate according to the loads. Then 1 month later, at the end of the month, then you will bill them. And then when they receive the bill, right, they will take about 1 to 2 months to process your check. And then by the time when you receive the payment, it will be 2 months or 3 months later. So which means your cycle of the collection is like 3 months of a cycle collection. Okay, and so there are certain business are like that, 3 months or some even 6 months. For some of the construction company, right, it's 6 months. The one that my family business was involved, right, it's 6 months. Okay, although it says 2 months, but then in the end it come up to be 6 months or more, and then later become a bad debt. Okay, all right, yeah, okay. So then how about this cash flow from the financing? What do you think? Financing meaning that you are, okay, let me draw you some picture first. Okay, so let's say this is the balance sheet. Okay, the balance sheet, you have the assets here, and then you have the liability, and then the equity, correct? So your assets is equal to your liability plus your equity, correct? Okay, so now we are looking at a business when they are looking at sources of fund. We are looking at funding. Okay, how do you fund a business? So how do you fund a business? You can fund a business through either the debt funding or the equity funding. Okay, this part here, do you understand? So when you're looking at the sources of funding for the business, you are looking at either you are borrowing more debt from the banks, or you are raising some equity in the form of a corporate exercise. Let's say you issue your rights issues, then you can get more equities funding, okay, or you sell more shares. So some of these like equity funding, or these some of this website whereby there is private company whereby they want to sell you the shares. So then they are doing a equity crowdfunding. Okay, so that means they are trying to collect a pool of money from investors, and these investors, they look at the business and then they really like the business, then they will buy the shares. So when they are buying the shares, they are actually contributing the money to you to do business. So then this is considered equity funding, and then the debt funding. Okay, now when it comes to the financing, these are the two main category of the financing, two main thing. So you can either go for debt financing or equity financing. So for example, if let's say, okay, let's say I need the money. So I said, okay, I'll go to the bank to borrow. Then you are involved with the debt financing. So when you are involved bank borrowing, right, then it will be considered as borrowing, and then the money will come to you, cash positive inflow. When you borrow more money, is when you have more borrowing, cash inflow. And if let's say you want to pay down your loan, if let's say you have a lot of cash and then say, okay, I have a lot of cash, so this, rather than sitting in the bank, I want to pay down the loan. So then it will be cash outflow. Then it will be negative when you are making the payment for the loan. Okay. And then when you are paying for your dividends, is also considered as a outflow here. Okay. So here we are looking at this section, whether do you think that it's positive is good or negative is good? Cash financing, cash flow from financing, is it positive is good or negative is good? Would you want to see more money coming in or more money going out? And consider healthy lah, okay, healthy. Okay, yes, very good. So meaning that If you see something like a negative here, so it means that you are actually paying down your loan, you are giving out dividend, you are just doing some very healthy corporate exercise or activity. Okay, so which means that in the summary, you prefer to have this one positive, and then you prefer to have this one, and then this one negative. Then it's considered a healthy company, right? Okay, so let me go into more detail on each of these. Okay. Okay, so basically, I repeat, when it comes to the operation, this one we are looking at our debtors. Okay, well, how fast we collect money from the debtors, and then our suppliers, creditors, how soon we pay them the money. Okay, so we do not want to pay this supplier first, then collect this one later. Wrong. Okay, the procedure is wrong. So you have to collect money first, then only you can pay the supplier. Okay, now then another one is the investing. So invest in what? Capital expenditure. Okay, so in short will be capex. So when people are looking at, oh, do you know what's the capex for this company? Let's say you are trying to analyze the Maxis, DG, and all this telco company, and then you want to find out the capex for this company on an annual basis for last year. So then you say, oh, how do I know the capex for this company? So this is the place. Okay, so you come to the cash flow statement, and then you look at the cash flow from investing, and then you look at the cash payment for their buying of the equipment, the operation, and all these equipment and tools and all these machineries. All these are considered the capex, capital expenditure. Okay, so that figure will be the capex. Then financing will be on the corporate exercise. So the corporate exercise can be you are borrowing from more debt, or you are borrowing from more equity, like share issues or rights issues, or private placement, or this kind of a corporate exercise. And also including the dividend payment as well. Okay. Okay. So now let me ask you, is it possible, okay, is it possible that you see a company with a cash reserve, the final figure for the cash flow statement, we call it the cash reserve, okay, the net final figure for the cash reserve, right, is a big figure, okay, it's a very big figure, okay, it's a very, very big figure. And then when it comes to the operation here, it is negative. Is it possible? Is it possible? The cash flow from the operation is a negative, but the overall cash flow statement, yes. How? How is it possible? How? How is it possible? Okay, you borrow a lot of money, or you borrow. Okay, that one is from here. You borrow. Ah, yes, Okay, yes. Disposal of your assets. Now, during the pandemic, I see a lot of companies, their operation cash flow is negative, or not negative, but very, very like a small figure. It has reduced because of the pandemic, but their cash flow statement remain healthy is because they have a lot of sale of their assets. They keep selling their assets, sell their land, sell their machinery, or whatever. They sell their assets because they need the cash flow in order to cover their operation. Otherwise, you cannot sustain in a pandemic where everything is locked down. Okay. So under that kind of a situation, right, then you will consider healthy because everybody is doing it. So then it's considered normal. But if let's say it is a normal business cycle where you do not have a pandemic, it's a normal business cycle, and yet you have a negative figure on the cash flow from operation, that means that you are not healthy. Okay. Okay, so let's continue. So next we look at the operating cash flow. whereby, okay, now this one is looking at the more details lah. So meaning that if you want to calculate the operating cash flow, you need to use the net profit plus non-cash expenses, which is your depreciation, amortization, accruals, okay? Non-cash expenses, and then you have to also add the changes in the working capital, okay? And then that will give you the operating cash flow. So you see net income plus your depreciation, and then this will be your non-cash item, and this will be your cash flow from your operating expenses. Okay, then you will see that your capital expenditure, your capex, will be deducted, and then that will give you the cash from your investing activity. Then after that, you will see that you pay a dividend, then you deduct from here, and then you have all these corporate exercise. Then you see the final figure is this net change in the cash. Okay, net change in the cash, and then you see that this is a positive figure. Okay, and then you compare. So net change in the cash, and then you see that there is a revenue. So then you can do a certain kind of a margin, okay, or percentage or proportion. So later, the next slide, I will show you what are the margin, okay? So then you need to, these operating cash flow figures, right, you need to compare back to your revenue, your sale revenue. So in this case, they have done a operating cash flow over sales figure here. Okay, so they are using the operating cash flow here, operating cash flow 483 divided by the sales revenue of 3200. Okay, this is the sales revenue 3200. So they are using the operating cash flow divided by the sales figure to give you the operating cash flow per sales. Okay, divided by the sales. So you are looking at 15%. Okay, later we will see some of the industry, and then what is this 15% mean? Is it big or small? Now from the outside, right, if you look at this, you look at 15%, right? Do you think it's good? This figure is good or not? Okay or not? 15%. You think 15% is okay or not? Like your operating cash flow as a percentage of your total sales is about 15%. So which means that you generate about 100K in your sales revenue. Out of that 100K, and then you have about 10K is from the operating cash flow. Is it okay? Is it healthy? Industry specific, yes. SC Chan, very good. Okay, yes. Industry specific, yes. So like I said just now in the beginning, there are certain industry whereby it is a cash business. Then of course you will imagine that this kind of a cash business, you must have a higher percentage, maybe 20% or more. Okay, so normally 20% is already quite a good figure. Now there are certain industry whereby it will be less liquid. For example, the construction, then maybe the 10% is considered quite okay already, and then maybe they will run into a smaller than that. But normally if it's less than 10%, I wouldn't think it's good, no matter which industry you are. Okay, no matter which industry you are, if it's less than 10%, which is not healthy already. Okay, all right. So cash flow from investment activity will be looking at your capital expenditure. So this will include your purchase and the sale of your property, equipment, and securities. Okay, you can also buy other people's shares. Like for example, you are Top Glove, right? You want to buy Massing shares, also can. Investment in securities, also can. Then okay, so here you can see that company, when they buy the machinery, it will be cash outflow, and then when they are selling, then it will be cash inflow. Okay, so in this case, you want to have negative rather than positive, because you want to see that the company is investing in capital expenditure so that they are growing their business. Okay, their operation, there shows that they are expanding their operation size. Then cash flow from the financing activity, we are looking at the corporate exercise, okay, which is loan, and then your equities, and all that. And then if you have a negative, it means that you are just healthy, meaning that you are paying down your loan and then you're giving out dividends, which means that you are healthy. Okay, so which means that you must have enough of your cash flow from your operation, big, huge enough in order to cover the negative from your investment activity and also the negative from your financing activity. So this company must be a very, very strong, financially strong company whereby the cash flow is from the operation is so huge enough to cover the other two sections. Okay. Okay, now we look into the free cash flow and the cash flow margin. So if you have any question, feel free to type in the Q&A. How to get the recording? The recording will be provided by either the live chat or the Bursa Malaysia YouTube channel. Okay. Okay, we included. Yes. Okay. So here we have the free cash flow. The formula will be operating cash flow minus the capital expenditure. Okay, so which means that just now we have a cash flow statement like this, right? And then we have the operation cash flow, and then we have the investment, and then we have the financing, right? So what it means here is that the operating cash flow, the figure here, minus your investment activity, minus, then you can get this FCF. Okay, so this is the most straightforward formula to calculate the free cash flow. Now, there's also another formula whereby you have to look at the net income plus your depreciation minus your whatever, then you can get there's a formula, and then only you can get the free cash flow. So either two, okay, either one will be good enough. So for me, I prefer this method, which is using the operating cash flow minus the capital expenditure, and then that is your free cash flow. And then with this free cash flow, then you will see that whether you have enough money to pay your dividend or not. So that is why, okay, so let me ask you another question. Let's say there are two types of investor. One type is called the capital gain investor, whereby you are more on the short term, okay, capital gain. You just want to see that the price of your share price go higher, then you will take profit from it, capital gain. So then there is another group of investor whereby you focus on the dividend. Okay, you just focus on the dividend, you don't care about the price, you just look at the dividend. So there are these two type of investor. Okay, so now tell me, which of these investor, right, will focus on the cash flow statement more, will like to see the cash flow statement more. And then there is also another statement, is called the income statement. Okay, so which of these will be focusing on the income statement? Yes. Okay, so the dividend person will go for the cash flow statement. Yes, that's right. And that is because the reason is because of this free cash flow. And this free cash flow will be the amount of money that people, all the dividend investors will be looking at, focusing on this free cash flow and then see whether they have enough of this money to pay your dividend, which is super important for the dividend investors. But however, for the capital gain investor, right, they will look at the net income, especially the earning per share. Because after you have calculated the net income, then you divide it by the number of shares, that will give you the earnings per share. So it is this earning per share will directly impact on the price action. That will give you the kind of a capital gain that you want. Okay, so then you know that these two types of a statement, they have their own purpose. So it depends on who is the user. So if you are the dividend, you focus on the cash flow. Okay. So free cash flow shows the financial flexibility, particularly the dividend. See whether you have enough of money for your dividend. And the cash flow margin also show your efficiency, how fast you collect your money, how healthy is your working capital. Okay, so you can comparing two companies with their free cash flow and then their cash flow margin, operation margin, to see how efficient they are. Okay, let me erase this. Okay, so you can see that you have here you have the net earning, which is operating cash flow minus your capital expenditure, and then that will give you the free cash flow. And then if you want to calculate your cash flow margin, you use your operating cash flow divided by your total sales. Okay, so these two. So these two are very important, especially the operating cash flow margin. It will tell you how efficient your company is. Okay. So next, we look at some of the red flags. So how do we know whether this company is in problem? We need to look at 3 to 5 years of the data. And if we want to see that this company is healthy and is doing well, then it has to be an upward trend on their operating cash flow or the free cash flow figures. So operating cash flow figure and the free cash flow figure has to be in an upward manner, okay, upward trend. And in terms of the ratio, we have to compare the year-to-year ratio analysis. And in terms of the tools, we can use the Excel worksheet or the financial software, but normally I will use the Yahoo Finance, okay? Yahoo Finance, and then you can extract the information, and then you can put in your Excel worksheet, and then you can produce the figures there. And then you need to distinguish between the strong company, which has a consistent positive trend. Okay. Okay, so here we are looking at some red flags. So the red flags will be persistently negative operating cash flow. So meaning that the first section, right, is already negative. So how do you expect the following section? So then you were expecting that this company will keep on selling their assets, because when the first section is negative, right, then that means that you need to get the money from your second section, which is investment activity, and also the third section, which is on the financing activity. So meaning that either you need to sell your assets, or you need to borrow more money, or you need to do a private placement or a rights issue in order to finance your negative from your operating cash flow debt. So then you also have see that your receivables, it's increasing, but then your cash is flat. Okay, so which means that your cash is not increasing together along with your receivables. And then your collection issues, maybe this company have some form of a problem with collecting money from the suppliers. And this kind of a collection issues, right, it will be normally very, very prominent, especially when the economy is not doing well. And especially when the economy is having some form of a slowdown, okay, and not doing well. So you see that the your debtors, they are not able to sustain themselves. So sometimes this could be happening in a economic slowdown, but sometimes even in a normal situation, right, it can also happen, and that is because your customers itself is not a quality customer. Okay, so sometimes you will run into certain customers which is not so quality, then you will have this collection problem. And then sometimes you are looking at this company whereby they have too much of a borrowing, then it will be a red flag. As for example, AirAsia during the pandemic, the borrowing was too huge, so huge until that there's no more banks want to lend them the money. So then they have to go for the private placement. Even they go for the private placement, also no use, because the expenditure is too big. You are looking at so many months. Okay, so for so many months you cannot fly, so you cannot do business, you cannot have any cash inflow, so you need to borrow a lot of money to sustain that kind of a expenditure. So in the end, they have to raise money from the NASDAQ, okay, to get the financing. Okay, so more red flag: unsustainable debt, sudden spikes or drop in the potential manipulation, or maybe the price. Okay, so maybe the cash flows figure a sudden increase or reduce, or sometimes you will see that why there's a sudden increase or reduce, because normally if you are operating in a normal business environment, your cash flow should supposed to be steady, okay? Because you are operating in a sustainable way, so it has to be steady. If let's say there's a sudden spike, that means that either you suddenly borrow a lot of money, or suddenly you have some kind of a cash flow problem because you are not able to sell your things. One good example maybe because it is a sunset industry. Okay, let's say your product that you're selling is undergoing a sunset industry, so that the customers are switching to the alternative product. So that means that you are losing your sales revenue in the first place. Okay, so then that will see that your cash flow will also be reducing. Okay. And sometimes it is also because of the industry is undergoing certain form of a transition. Okay, say for example, an example only. Let's say this is a semicon company producing the chips. Okay, and then when you are producing the chips, right, you are looking at collection money from your customers. Now, let's say you lose a major customer. Okay, let's say your major customer is Dyson. Okay, and then you lose Dyson as your big customer, and because your competitor maybe from China is able to produce even cheaper chips than you do, so then Dyson has gone to another competitor. So then you lose a big client. So when you lose a big client, then your sales revenue will drop. So when your sales revenue drop, then you see that your cash flow will drop also. Okay, so that is one example. So another example, maybe your customers are still there, but because of the technological breakthrough, you need to put in more money in the R&D. You need to put in more money into the capital expenditure. You need to put in more money in the new infrastructure. Your revenue is still the same, but then your capital expenditure has gone up. So then you see a spike in your cash flow because of the environment. Okay. So sometimes you see that the weak companies often show volatile or negative trend. Okay. Okay. So okay, one question from here. Yeah, wait. Back to. Okay. So one question from the Q&A here. Okay. Accounts receivable is the money yet to be received. If company counts it to cash inflow, how about if it turned out to be a bad debt? Yes. So for accounting purpose, right, there will be accruals. Like if let's say certain loan, certain receivable, you are not able to receive for more than a certain months because there are some accounting rules, right? So for more than certain months, right, then it will be classified under the provision for bad debt. You have to deduct it. Okay, you have to deduct it. So the accounting rules have already put everything in place such that they wouldn't you wouldn't mislead people because they want to make sure that the users of the financial statement is being protected. Okay, so when you see that the certain bad debt you are not able to receive, right, then you'll be considered as a bad debt and then it will be expensed out. Okay, yeah. Okay. So let's look at this case study. So this one is Inari. Okay, so Inari is our chip company. It's a technology semicon industry. Actually, they have a few business line. Okay, the OSAT is one of it, and then they also have the EMS, and they also have equipment as well. Okay, so they have a few line of a business, but particularly they are also looking at expansion as well. So now they are going to upgrade their facilities to include the advanced packaging as well. So advanced packaging is looking at trying to package the advanced chips. Okay, so traditionally you are looking at the legacy chips, right? So now you are looking at packaging the advanced chips. So then that will take them some time to build the factory. or to build the facilities by next year, June, around the mid of 2026. The facility will be ready, and then they will be able to receive the orders and then to produce the advanced packaging sales revenue. Okay, so that is the background. And in financial year 2025, the company reported revenue of approximately 1.35 billion, with a robust cash position of 1.73 billion. Okay, underscore the financial strength, enabling dividend and all this. Okay, so let's take a look at their financial here. So this figure you can get from Yahoo Finance. Okay, so later we will look at the Yahoo Finance as well. So under the Yahoo Finance, you have the income statement so that we can see the sales revenue. Okay, how much is the sales revenue? And then you can also see the cash flow statement here as well. So you click the cash flow here, then you can see the cash flow. Under the cash flow, you can see operating cash flow here, investing, and then the financing, and then the end cash position. So the operating cash flow is this 321,799. So if we want to calculate the operating cash flow margin, okay, the OC operating cash flow OCF margin. So what is the formula? So just now we say that when the operating cash flow margin is using the operating cash flow divided by the sales. Okay, so let's try to use our calculator. Okay, we use 321,799 divided by 1351. Okay, divided by 1351937. So the operating cash flow margin is 23.8%. Okay, 23.8%. So this figure, is it good or not for a cheap company like this? Okay, so this figure, is it good or bad? And then you look at, and this is the trailing 12 months. TTM is the trailing 12 months. We can, which is this figure. Okay, so let's say we use this figure 1.478 compared to 515. Okay, so I use a round figure, 515 divided by 1478, right? Just now 1478. So it's 34%. Okay, 34%. So let's use another figure, 1354 and then 418 divided by 1354, 30.8%. Okay, I just look a few figures lah. Okay, 31% round up. Okay, so we just look at this figure, right? What do we get from here? Okay, what do we get from here, the trend? Healthy, concerning, what is your thought about this? Still okay, acceptable? Declining, right? It's declining, but is it still acceptable? Is it still acceptable? It's dropping, yes. I would think it's still acceptable for a manufacturing company like this, right? You can get 23.8% is very good. Okay, let's try to look at VS. Okay. Okay, we look at the VS industry. Yahoo Finance, I'm not sure whether Yahoo Finance have the it doesn't, maybe some of the major stocks they have, but VS industry, I'm not sure whether they have. Okay, we can try to search. VS industry. Okay, it doesn't have. Okay, let's try to look for another tech company. Any tech company you want to look at that can compare with no tech That can compare with Inari. I want to compare within the same industry. Tech company, NationGate, okay? Okay, the company have to be big enough, otherwise it won't appear in the Yahoo Finance. Together. Okay, and NationGate has, okay? So normally you can find these under the financial here. Okay, let it. Okay, so NationGate 1.26. So we click the financial here. Okay, so it's loading. Then you see income statement, right? Okay. So, and then the cash flow. Okay, so the figure is too big. I need to write down, otherwise I cannot remember the name. Or I can just round up lah. Okay, so total revenue, I will take this 2024. Okay, this is a trailing 12 months. Okay. Wow, the trailing 12 months is such a big figure. Okay, this figure is a bit funny. Okay, but anyway, I just copy lah. Okay, trailing. I look at the trailing 12 months figure 9,826 million or 27. Okay, I round up, and then I click the cash flow. You see the cash flow is already a negative figure there. Okay, so negative figure you can't calculate. When you see a negative figure, right, that means you cannot calculate already because it's a negative. Okay, so that means it's not healthy already, so no need to calculate. So another one, Penta Master. I hope Penta Master it will be more healthy. Okay, so the financial under the income statement is 557343. Okay, so this is the trailing 12 months, and then the cash flow. The cash flow is 86. Okay, 86647. Okay, so I use my calculator. 86647. Okay, 86647 divided by 557343. Okay, 557343. So it's 15.5%. Okay, so this one is 15.5%. Okay, so 15.5% to this is also considered quite acceptable. So which means that just now the Inari, right, 23% is very good already in the industry. Okay, we look at one more, which is the tofu. Okay, then tofu. Okay, maybe it doesn't have. Oh God. Okay, if this one is too slow, I will use my laptop then. Maybe I'll use, okay, never mind. So financial and here, financial. Yeah, I will use my laptop. faster. I use so financial. Okay, so here the income statement is 271860, and then the cash flow 47 47911 divided by 271,860. Okay, so it's 17.6%. So Tufu is also quite okay, 17.6%. Just now, the previous company was 15 only, right? So this is 17.6. And then of course, the Inari will be the best. If you to ask me the cash flow statement, Inari will be the best among all the tech company. Whether it is a Vitrox or Gtronic, I think it will be the same. Gtronic, if you to look at their cash flow, right, you will see that their cash flow actually declining quite fast. So, but this Tufu, right, you can see that their cash flow, see whether it's healthy or not. You look at their cash flow, So you see the cash flow from operation is actually declining. So this is a trend for all the tech company. If you see, it's a trend for all the tech company. So this is Tufu, right? So then you look at Vitrox. Financial cash flow. Okay, so you see the cash flow like 167 million, and then this one become 121. Okay, at one time it was 39, so now 121. Okay, so some form of a decline. And then you look at another one, Gtronic. Okay, Gtronic has gone into negative already. Okay, because you see that it keep on dropping until it become negative. So then you know that the alert, the warning sign is when it is declining. Okay, the alert sign is that when it is declining, keep declining, then you know that something is wrong. It could be the industry. And you can check the revenue. Okay, the revenue also declining because previously it was 200 million, then become now is 110, half of it. So the revenue has half of it, and then the cash flow is gone negative. So then this is having some problem there. Even the Inari, just now we didn't see the trend. Actually, you were able to see the trend is actually falling as well. So get the financial cash flow. Okay, so you see the cash flow last time was 500 million, then now it is about 300 million. So you see it's constantly declining. And then their income statement, still okay. Okay, the revenue still okay because here you see 1.5 B, 1.3, 1.4, 1.3. So it is still maintaining. So among all these tech company, right, I would say that Inari is the more better one in terms of their revenue trend and in terms of their cash position. Okay, so you can check like this. And another thing is that if you want to know whether, if let's say you are the dividend person, right, you want to check their free cash flow. Okay, so basically you want to use this operating cash flow minus your investing activity, that will be your free cash flow, just by looking at that. So from here, you see, is it enough to give you dividend? 321 minus 230, is it enough to give you dividend? So you see their financing activity. Yeah, I cannot click, so I cannot see the breakdown. I can't see the breakdown of their dividends payout. But however, you can see that here you do see that the company is paying off the loan and also giving out dividends. And so that's why it's negative. And then here they are also investing on their facilities to build a new facility like advanced packaging facilities for the company, which is good. And this is their cash inflow. Okay. Okay. One MPI. Okay, later I want to look at the construction. So MPI, what is the full name? Malaysia Pacific, is it? Okay, search again. Malaysia Pacific. Financial. Okay, first, how about the revenue trend? Revenue trend, slight decline. Okay, still okay. Then you look at the cash flow. Cash flow last time was 700 million, so now it's about 455. So it has gone down by about 30, 40, okay, 30-40%, like that. Okay, so which means that this is also showing some form of a decline in the cash flow. So do you see that this industry is facing some form of a structural change? Maybe the revenue maintained, but then however, they maybe have to incur more capital expenditure. So for example, you see that this capital expenditure by far is the highest among all of these. Like 2023-24, you see that the capital expenditure is about 200 over million, right? But then when it comes to this trailing 12 months, right, it's about almost like 1B. So which means that this industry, right, maybe they are undergoing some form of a challenging moment whereby they need to upgrade their facilities so that they can get more new orders. Okay, because the traditional legacy chip, if they were just to rely on the traditional chip manufacturing, maybe is outdated already. So they need to upgrade, have some form of an upgrade. So they need to put in a lot of capital expenditure. So if you are the investors, you have to understand this, and then so that you want to assess whether you want to buy this is for the dividend purpose or you want to buy this is for the capital gain. So you need to assess yourself. So next, I want to look at the Gamuda. Okay, so financial. Okay, in terms of the revenue, no doubt, no problem, right? Because you are looking at the book order of 37 billion of a book order. So in terms of the revenue, no problem, because you see the revenue 3B, 4B, 8B, 13B, 15B. So definitely no problem. Okay, so now we look at the cash flow. Okay, you look at the cash flow, right? It was almost like 1B. Okay, then become 400, 100, and then now back to about 1B. So then you look at the capital investing expenditure. Investing expenditure is also a huge increase as well, which is also like 1B as well. And then the financing activity is coming in. That means you have either more borrowing or corporate exercise. If I'm not mistaken, they have a rights issues, right? Or the corporate exercise. So then that will be looking at that money coming in. Okay, so maybe more borrowing or corporate exercise. So which means that in terms of the cash flow, we do see some form of challenging moment. It's because of the huge capital expenditure, and then plus you need to borrow more money, and then now we need to look at the ratio. Okay, so this is 1B, and then you compare to 15.8B. Okay, so 15.8 divided by, oh, so it's just 15.8%. So if you are looking at this 15.8% of cash flow operation, is it healthy for a construction company like this? It's quite healthy. Okay, but however, you can try to look at others as well. We need to look at the previous as well, like 13B over this cash flow of the, okay. This 2024 will be a big problem there, is because 152 divided by this big figure, the operating cash flow is a very, very small figure. Okay, so which means that because now you are looking at the trailing 12 months, right? So we need to see the audited figure and then to see, so that is some form of a we can see some form of a conflict there, is because the trailing 12 month is showing some very good figure, which is 15% of a operating cash flow margin. But however, the 2024 yearly figure, right, is showing a very small margin. Okay, because you are using 152 million divided by 13B. Okay, so 152 million 152 divided by 13,13346. Okay, so you're looking at only 1% of operating cash flow margin. So that is a very alarming figure. Okay, but however, if you look at previously, let's say 2023, 8.2B. Okay, 2023 will be 404 divided by 8200. 404 divided by 8220. 8220. 4.9, about 5%. So which means that the 2023, right, the operating cash flow is also quite low, which is 5%. This 2024 is 1%. This one is 5%. And then let's take a look at the 2022. Okay, 2022 is 470. Okay, 470 divided by 4902. 4902. About 9.5%. So the operating cash flow, right, is like actually ranging in a very big range, from 1% to 15%, and then in the middle you have 5%, you have 10%. So the operating cash flow is a very, very big range. So which means that this construction company, right, they are actually struggling to manage their cash flow very, very well, because they have received so many international projects, which means that they have to manage their cash flow well so that they can ride through this this kind of a challenging moment. Okay. We can also look at the Suncon. Okay. No, we are looking at the cash flow. Okay, so currently we are looking at the cash flow, so we are not looking at the net profit. Okay, because the cash flow is using the net profit plus the depreciation and then minus all this plus the working capital, change in the working capital. So we are actually looking at the cash flow statement, not the net profit. Okay, so because when we look at the cash flow, right, we want to focus on whether their ability to pay dividends. Okay, and then whether this company is operating in a healthy manner. Okay, so another one is Suncon. Okay, we want to compare two construction companies so that we can see that whether they are in the competing well or not. So Suncon, and this one is the. So first, their income statement is also rising very well, right? So that is no question about it. And then their cash flow statement, interesting. So initially, they have some form of a negative operating cash flow, but these recent years, it's all very positive already. So by the trailing 12 months, it's about 1571. Okay, 1571 divided by 5143. So it's about 30% of operating cash flow. That is, I think, is a bit of not realistic, because it's too good to be true. 30%, and then 2024. Let's take a look at 2024. 716 divided by 3521. So this 2024 is about 20%, which is also quite good. And then let's take a look at the 2023. 2023 is negative. Okay, so which means that the construction company, right, the cash flow is their main problem. You see, from somewhere you can see from negative to positive. And then for positive, it can be so huge a positive. And then for the Gamuda, it can be from 1% of the operating cash flow margin to 15% of the operating cash flow margin. So the range is so big. So which means that the operation-wise, the construction is a challenging moment, okay, especially looking at their cash flow. Okay, yes, Satya, SP Satya. Okay. Financial, cash flow. Okay, we look at the income statement first. Okay, income statements. Oh, there's no figure. Why is there's no figure? Cash flow. Okay, there's no figure for the SP Sadia. Okay, so maybe they haven't updated. So another one is Masing. Okay, Masing have figure. Okay, so the revenue healthy. Okay, and then look at the cash flow. The cash flow is also healthy in a way is that also ranging. Okay, so it will be also like bumpy as well. You have one shot up like 1B, and then now you have half of it, the 500. So there is some form of a volatility in the cash flow. So construction and properties, these two are very volatile in terms of their cash flow because it's the nature of their business. And 581 divided by 2599. 581 divided by 2599 times 100. Okay, so 22%. Okay, consider okay. Okay, let's take a look at the 579 divided by 18. Okay, so it's about 20% also. So Masing is okay. Quite healthy. Okay, Eco World. Okay, another one. Eco World. Okay, I need to have some time for the ETS. Okay. Echo. So here we are looking at the financial. Yes. Echo World in terms of their revenue progressing well, and in terms of their cash flow quite steady as well. Okay, very steady. I would say that it's quite steady. 900 divided by 2. Okay, I just round up the figure. For 36, very healthy. Okay, so Echo is very healthy in terms of that cash flow. Okay, so but however, if you want to see whether you got enough of a dividend, you have to see this. Although the cash flow is healthy, right? But you can see that they're having a lot of capital expenditure because there's a big outflow in the investing activity. And then from the financing part, they are also raising the money from borrowing as well. Because if there's no exercise, no corporate exercise, we didn't hear any corporate exercise from EcoWorld, right? Then we will assume that this should be the borrowing from the banks. So before they have been negative, but now, so which means that probably you won't receive dividends from EcoWorld. Probably, okay, you won't. If they want to give you dividends, meaning that they are giving you the dividends from the reserve, their accumulated profit. Okay, so which means that it will be harder for them to give you dividends. Okay, so I hope you have a better understanding by looking at so many cases. Okay, CS, can we the CS, I have already answered your question, right? The net profit calculation one, I have already answered your question, right? Okay, so then next is the ETS. Okay. For ETS, right? Last session, I think some of you have a problem logging onto the platform. Okay, so for some of you who have problem logging into the Bursa ETS simulation section, you follow my this instruction. So I have actually tried to log in using the mobile data. If you were to use your Wi-Fi, you may have problem of logging into this ETS. So you need to use your mobile data. So what I did is that I'm using my mobile data to do a hotspot. Okay, so then my PC will be logged on to the hotspot of my mobile data. Then only I can open up this. Okay, so for some of you who have problem logging in, that is because you are using a Wi-Fi. Okay, if you are using a mobile data, you should have no problem. Okay, so you try to log in. We use the Bursa. You click the Bursa Malaysia website. Okay, you click the Bursa Malaysia website. Okay, how many of you have not registered this one? Anybody not registered yet? Okay, you may want to register because this is a simulator whereby you will use a virtual money. You'll be given 100K of a virtual money to buy the shares. Okay, so we'll see. So you log in and then you go to the, here you log in, okay? You log in with your, register with your email address. Then only you go to the market. Under the market, you click the tools. Under the tools, it is the equity simulator. Okay, so I repeat, under the market, tools, and then equities simulators. So then you click the equity simulator, then you will come to this trading portal. Okay, so these are live. So today live, we are looking at our KLCI index has increased 1 point. So it's 1,600. Okay. So let me demonstrate to you. How many of you have not registered? Okay, so if you have not registered, you may register now and then you see whether you can come to this page or not. So what I want to demonstrate to you is that, okay, Emil, very good. I want to demonstrate to you how we can utilize this platform. Now, this is a real-time simulator. Okay, it's a real-time, it's ongoing. So all these are ticking, so it's ongoing. So what we can do is that first we need to create a watch list. For any new investors, right? Normally, the very first thing you want to do is to create a watch list so that you can keep track of the stocks that you want to buy. So you will do this, okay, the watch list, and then you click create watch list. And then you put a name. Let's say you want a dividend stocks. Okay, you put dividend stocks, and then you will create a watch list. Then you have to look for dividend stocks, then you can put in there, right? So then you look for, you type here Maybank. So you see Maybank and then you click, then this will be the Maybank, and you do a right mouse click. Okay, right mouse click, add to the watch list, dividend stock add. So then my watch list has Maybank. So view my dividend stock. So then this become my watch list. Okay, so then I want to add another one, CIMB Bank. Then I will do a right mouse click and add to the watch list. Add. And then my CIMB Bank will be appear in my watch list. So then you just put in as many dividend stocks that you want to keep track so that when you are monitoring the price, it will be easier for you. So whenever you see, wow, this Maybank has dropped, so I go and buy some more. Okay, so you monitor the share price that you want, and then you can buy from there. So for example, I want to buy Maybank, so then I just click, and then right mouse click, and then I click buy. Then this will appear. Okay, this will appear. So then I will be given 100K. Everybody will be given 100K. So then this will be your paper money. So then you can use this to buy the shares, and then you can use the knowledge that you learn from me. For example, today I teach you just the cash flow, right? So you just look at the cash flow. But of course, in analyzing the stocks, you have to look at many things. You have to look at the industry outlook. You have to look at the earning per share. You look at the PE ratio. Look at the book value. You look at the debt equity ratio. You look at the market cap. You look at the ROE. Okay, dividend yield. You look at all these criteria. But the cash flow statement is just one of the criteria whereby you can show whether the company is healthy or not, whether the company is able to give you dividends or not. Okay. So here I can click buy. Okay, let's say I want to buy 10 lots. 10 lots means 1,000 shares. Okay, so 1,000 shares is 9,850. So then I key in the limit price. Okay, because I know that the bid price is 9.84 and the ask price is 9.85. So I want to buy directly from the ask price. I want to buy immediately. So I click 9.85. Then I click buy. Click OK. Then you submitted, and then you can check your orders here. Okay, so this is your orders here, order book, order status. So then you can see that it's partially filled. Okay, so by a few minutes time it will be fully filled. Okay, because I put the instruction is a limit order, but the limit price is the selling price, the offer price, which is the higher one. Okay, so that one mostly immediately you will get it. If you want to queue at the bid price, it will take a longer time. Sometimes when you queue at the bid price, right, the price just keep on going higher and higher, and then you may never get it. So then you forget about it. Then the next day you look at it, you see the price is so high already. Then you say, "Aya, I should have bought at the offer price." Okay, so sometimes just that 1 cent, I don't, because after all this is for long term. So that 1 cent, don't bother. Okay, you just buy the offer price. Unless you are looking at trading. So if it's trading, then every single cent counts. Okay. Okay. All right. So any questions for this cash flow statement and also the ETS? Okay, because we have come to the end of the session. Any questions? Okay. No questions? Okay, let me check the Q&A. Oh, okay. Q&A have a lot of questions. Okay. Case study on Amway and RCE. Oh, okay. How do you spot the correction issues, overdue, receivable? Okay, correction issues is something that we cannot be, as an outsider. We are not the insider, right? We are not the people, the staff there. We cannot. So then we can only look at the industry, the normal practice of the industry. Okay, for example, the construction, the manufacturing, that kind of a thing. Otherwise, it will be very, very difficult for you to spot. Okay, so I have to agree with you. It's not easy to spot. How does the Yahoo calculate the free cash flow? Normally, whether you are using the net income plus the depreciation minus, or whether you are using the the operating cash flow minus the cash flow from investing, it will be the same answer. Okay, whether you use these two, you will be the same answer. So I suppose they will use either one of them. Okay. If a stock doesn't offer dividend stocks and they have steady financial flow, is it still worth buying? Okay, so Woon Hui, okay, this is a very, very good question. Now, there are quite a lot of stocks are like that. They have a very good revenue, they have a very strong net profit margin, everything is good. Just that they don't want to give you the dividends. Their dividend policy is limited. So meaning that they are not willing to give high dividend. They want to keep all the cash. So there are, okay? So if you look at the track record and see this company is not willing to give dividend, then you are the dividend investor, right? Then would you want to invest? Of course, there are so many other choices for you. So you don't have to go to, you don't have to invest. There are so many choices out there. Okay. Okay, so then one last one is the M-way. Okay, so let's look at the M-way. Okay, a quick one. M-way. These are the consumer stocks. Okay, consumer. So for consumer, we will assume that their cash flow is supposed to be healthy, right? So let's take a look. Okay, now what I can see is that the revenue already declining. The revenue is declining. And then let's take a look at the cash flow. The cash flow is having some negative there. Okay, and then the trailing 12 months is 35. So which means that this company, right, I think probably they are having some form of a industry structural problem. Maybe people are not buying their products. Okay, so they have some problem in the sales. Then okay. Okay, where can I learn more detailed course or refer to the calculation practice? Yeah, because all this is recorded, so it will be uploaded in the Bursa Malaysia YouTube channel or LiveChamp, LIFECHAMP, LiveChamp YouTube channel. Okay, so you can refer to these two YouTube channel to see a recording of this session. Okay, so I hope that my session helped you or benefited you. And then if you want to learn more, you can follow the LiveChamp and also the Busa YouTube channel, and then they have some of my past recording as well. Okay, so I've come to the end of the session. I'll pass back to Atira.
Thank you, Miss Pauline. So, wait. Before I end the session, does anyone have any final questions? I think so. I don't think so. So we proceed up for the next session. With that being said, that is the end for our Q&A session. So I would like to sincerely thank Miss Pauline Yong for taking time to answer all the questions and share your knowledge. Thank you, Miss Pauline.
Thank you. Thank you, everyone. Thank you, Atira. Thank you.